to measure fair market value or fair value. The three ways are at the bottom, page 134. The three methods are called approaches, they're called techniques, they're called methods, whatever. It's called the market approach, the income approach, and the cost approach. You can see them at the very bottom, page 134. They're in bold print. The market approach uses prices and relevant information from market transactions for identical or comparable assets or liabilities. That would be like a quotation from the New York Stock Exchange or the NASDAQ Stock Exchange. That's considered the market approach. The cost approach relies on current replacement costs to replace the asset with a comparable asset adjusted for obsolescence. The cost approach is like when you have a used car and you want to see what's the value of your used car. You go on the internet and you look up the Kelley Blue Book value. Of course, it's not the exact identical thing as your car, but tells you about the make and model of the car, whether it's in good, fair, or poor condition, the mileage, the type of options that the car has. So it's something similar, and that's the cost approach. So you're comparing your asset with something similar to it. If you don't have something similar to it, then you're stuck with using the income approach. The income approach uses present value techniques to discount cash flows or earnings to present value amounts. So basically, management has to come up with estimates using present value factors, and they estimate cash flows based on earnings or cash flows, and they come up with a value that way. Okay, so a discounted cash flow system. Basically, they call these level 1 and level 2 and level 3. If you turn to page 135, the third paragraph down on page 135, they talk about level 1. Level 1 uses quoted prices in active markets. That's the market approach. Level 2 has inputs that are directly or indirectly observable inputs other than whatever you get in level 1, which is a market price. Level 2 would be like the cost approach. And then finally you have level 3. Level 3 inputs are unobservable inputs. They can only be used to measure fair value if you don't have a level 1 or level 2 measure. So level 3 would be the income approach. So basically you have a hierarchy. Level 1 is the best, which is the market approach, which is an identical item in that like a quoted market, like the New York Stock Exchange. Level 2 is when you find something that's comparable to your asset, like a Kelley Blue Book value. That's a cost approach. If you don't have a level 1, you have to use level 2. If you don't have a level 1 and level 2, then you're stuck using level 3, which is called the income approach. We use present value discounted cash flow techniques. Okay, when at all possible, you are to use. Okay, when at all possible, you are to use the highest level, and level 1 is the highest level. Then level 2, then level 3, and they're commensurate with the approaches market, cost, and income. All right. Towards the middle of the page, after they discuss level 3, it says, if an asset is measured at fair value on a recurring basis, disclosures are required in both interim and annual statements that identify the level of the hierarchy. If level 3 inputs are used, the total gains and losses for the period, realized and unrealized, the effect of the measures on earnings for the period, purchases, sales, issuance, and settlements, and any transfers in and out of level 3 should be disclosed. For annual reports, the valuation techniques used to measure fair value must also be disclosed. So these are disclosures. Then the last paragraph for Standard 157 says, for assets and liabilities measured at fair values on a non-recurring basis. A non-recurring basis would be, for example, like an impaired assets. Disclosures are required for interim and annual reporting periods that identify the fair value measurements used and the reasons for the measurements, the level within the hierarchy, and the description of the inputs used for any level 3 measurements. For annual periods, disclosures are also required for the valuation techniques used to measure fair value. All right, what I would like to do now is take a look at some multiple choice questions that involve standard number 157. I probably won't finish all the multiple choice questions that I want to do, but I just want to point some out to you, okay? This is very important only because it's been so controversial, but remember at any time the SEC could just say, bullet, because of that law, okay? Plus they're conducting a study on it right now. Very controversial. You should, I go, every day I go on the SEC website and I see all the comments that people post because they're conducting the study on fair value. And let me tell you, the comments are extremely controversial, all the way to get rid of the FASB. It's just funny. FASB, you're wrong, you're no good. What were they thinking when they wrote this accounting standard? Oh, it's you know what people say sometimes. Really sometimes their views are quite extreme. Okay. All right. What I think I'm going to do is I'm going to end on this disc, and what I want you to do is open up your books to page 150, and we're going to start with multiple choice number 62. I'm going to do now a whole block of questions on standard number 157, okay, what we just went over. So turn your books to page 150, and on the next disc I'll continue, okay?